Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Oil prices are falling after the U.S. and Iran tentatively agreed to extend their ceasefire and reopen the Strait of Hormuz. Iran insists any agreement must include an end to the fighting in Lebanon, but Israel's defense minister says the country will not withdraw. Prime Minister Mark Carney says the war in Iran will be the main topic at the G7, adding he will have an opportunity to see what Canada and other countries can do to help reinforce progress. He also says the war in Ukraine will be a key issue. And shares in Payoneer are getting a boost today after news that Canadian fintech Nuvei agreed to buy it for $2.7 billion US. We spoke with Nuvei's CEO, who says the deal creates a unique infrastructure.
We've been focused on building infrastructure to enable every payment everywhere. And Nuvei has been extremely successful on the pay-in, helping our customers, connect with their customers to collect funds in currency in markets where they operate around the world. Payoneer allows our customers to have virtual bank accounts and be able to receive funds from multiple sources. Typically, where Payoneer operates are Amazon, Etsy, eBay, TikTok resellers. Well, they'll consolidate that, receive the funds, and then enable real-time cross-border payments.
And we are, of course, watching the TSX today. It is up by 0.8% at the moment, driven by the materials sector. We're also watching U.S. markets, which are driven a lot by the tech sector today. A lot of the big tech stocks are up, but also we're seeing potential for a peace deal between the U.S. and Iran, and that has investors feeling optimistic. You can see the NASDAQ up by almost 3% at the moment. As you just saw, markets are rallying today after Iran and the U.S. announced they've reached a tentative deal to reopen the Strait of Hormuz. Oil prices are slipping, equities are climbing, and fears of inflation rising globally are starting to ease. So here to talk about that and more is Pierre-Benoit Gauthier, Vice President of Investment Strategy at IG Wealth. It's good to have you join us. Thanks so much.
Pleasure as usual.
So how significant is the broader market outlook given we're seeing the price of oil really sliding today?
Well, it's a funny little machine. Every time that there's rumors of peace treaties and peace deals, market goes up. But when the fighting restarts, market don't go down. So far, the markets love this rumor, this news today. And you can see, as you said very well, the Nasdaq is doing great. But energy importers like Japan up 5% on the news. So it feels like in this environment, the market appears to be looking at any reason, any excuse to buy, right? Because in itself, this news has been mostly phoned in, has been talked about before, and there's barely any specific details about what the peace plan will look like and if it's actually enforceable, and still the market trades it as so. Why is the market behaving like this? For us, it all goes back to earnings. When we had the latest earnings season with such incredible growth all around, and looking at Q2, looks like it's going to accelerate into the strength. The market is not willing to sell into that strength, and any good news is good news.
What will the price drop mean for consumer sentiment and spending in the second half of the year? By price drop, I mean the price drop of oil. If this peace deal is in fact signed, because as you mentioned, we've heard this before.
Yeah, exactly. No, that's a very good point, because gas prices obviously are a tax on the consumer. They are a tax upfront at the pump, but coming in later as more costs, transport costs for goods and so on. So it helps with the mood of the consumer for sure. And it also kind of helps with Kevin Warsh and Tiff Macklem's kind of weird little spots they have both got themselves in. On one end, in Canada, there's a very weak economy, very weak consumer. We saw that we entered a technical recession, even though that label is probably past its due date already, and we see the per capita GDP going up ahead, but still, economy is not that great. And what Macklem has a hard time cutting into it, because doesn't really know what the U.S. move will look like and needs to defend its currency. On the other side, this week, We'll have the first meeting from Kevin Warsh, where we'll meet the man and learn about his new style of communication, which he said before that he intends to communicate less than what we saw previously with Jerome Powell. Now, his situation is really special because he got hired on the promise, or at least on the speculation, that he would be a very dovish Fed chairman, that he would look to lower rates. But he comes in with a very strong economy, strong employment, and rising inflation. Our models indicate that inflation could rise to 5% going into the midterms. So very difficult to see a new Fed chairman cutting into that kind of environment. And we saw that expectations for rates are extremely volatile these days.
It's interesting when you say he said he was going to communicate less, or you feel he's going to communicate less compared to the previous Fed chair. What would that do for the markets, I wonder? How do you really make a decision when you're hearing less from the Fed? That's
very interesting. And those of our listeners, those of us who've been there for a long time, I in my career, I've lived only through a very talkative Fed, because I started my career in 2006, so around the great financial crisis. But before that, historically, the Fed used to say a lot less. And that's, in fact, if you go back further, at a point, the Fed didn't say anything at all. There was surprises all around. So I think there's a middle ground. Right now, the new way the Fed is communicating its decision, they are talking all the time. There's always a Fed governor somewhere speaking and having their speeches analyzed. The old press conference and all the analysis on the speeches, each word is dissected. It has become a theater. It has become too much. So I think that it's widely accepted, widely understood that we have gone too far, and we scaling it back down a little would probably help us all and reduce volatility overall. Because overanalyzing every single word like we do now seems a little unhealthy.
Good point. I want to go back to the markets as a whole, because we're seeing a lot of big takeovers, big IPOs right now. Just saw a big one on Friday. Should investors worry about a market top at this point, do you think?
Yeah, that's a big question we get asked all the time these days, because there's kind of a trauma, right, that has been associated with high IPO periods. The last one we lived was in 2021. In 2021, it was a crazy IPO year, and we saw that it coincided with a market top. But these IPOs were vastly different. They were IPOs based on a theme that was still not making a lot of revenues, and the frothiness, the extreme interest of people into these IPOs was a lot stronger than today. But if we go back further, look at Google and Facebook. Google and Facebook were huge IPOs from very well-known companies that people used every day, much like Anthropic and OpenAI business models. But they came in the middle of a cycle. There was neither the beginning of the end of anything. If you go back even further, in the dot-com era, people love to compare the current market to the dot-coms. But remember that Netscape IPO'd in 1995. The biggest IPO year in terms of quantity of companies coming into market was in 1996, years before the bubble eventually popped. And I've been using this example a lot lately, but I want to share it with you here. Palm, the company Palm, you remember the Palm Pilots, the little gadget, electronic gadget. Well, when Palm became public, the stock on the first day shot up 150%. And at some point, Palm was worth more than 3Com, who owned 90% of Palm. So that's the kind of crazy market stuff that can happen in bubble, in frothy territories that we are just not seeing right now. So maybe there is a bubbly aspect to this market in some areas, but as a whole, it seems still healthy to us.
Interesting. Okay, Pierre-Benoit Gauthier, Vice President of Investment Strategy at IG Wealth. Really appreciate your time. Thanks for joining us.
Anytime.
Coming up, airline stocks are up after the U.S. and Iran have reached an interim peace deal. We'll get more insight on the industry after the break. Airline stocks are rising after the U.S. and Iran reached an interim peace deal. The news has already pushed oil prices lower and could have important consequences for airlines and travelers globally. We got more from Robert Kokonis, President and Managing Director of Air Trav Incorporated.
It's tough to catch a break in our business. You go back to 9/11, SARS, the global financial crisis, the more recent COVID epidemic, and now, this conflict. Oil, gas price, fuel prices are the most expensive input for airlines, going from maybe 24% on average of total OPEX last year to upwards of 32% this year. So I think just hoping that we start to see a retreat in jet fuel pricing.
What's the bigger risk for airlines? Is it higher fuel prices or having to avoid certain airspaces?
Well, certainly you have to avoid any airspace where there's conflict over that. And of course, as we know from the Middle East conflict, we've seen, plus the Ukraine conflict, we've seen flows of aircraft having to divert and add, in some cases, several hours onto a routing. So that makes route profitability very, very tough. I would say that, the carriers overall are doing a reasonable job of mitigating some of that pain. Lufthansa Group, for one, they're looking at an extra $2 billion this year, $2 billion, and they're hoping they can mitigate a good chunk of that through higher fare prices, other issues. Air Canada has said much the same thing. They're looking at acts between raising fares, raising other items, and also cost reductions and network optimization. So that's good. Some of the carriers, though, don't have as much pricing power. The carriers that don't have pricing power in the marketplace, it will be more difficult for them to mitigate some of these or a lot of this pain.
Okay, because I was going to ask, should travelers expect cheaper airfares if oil prices continue to go down, if we see a resolution to this conflict in the Middle East? Because recently we've seen prices for flights double, but it sounds like maybe we shouldn't expect cheaper airfares. Is that right?
Well, it depends on the route and it depends upon the market and how much competition there is there. I think we had to cycle back to, will jet fuel prices return to normal quickly? And the answer is basically, for me, is no. It's a structural issue. There's a lot of factors going on. I mean, with supply lags, you just can't get your crude oil production in the Gulf region and all the refining capacity, refining distribution back up to normal. Optimistically, we're saying 3 months, but it's likely going to be a lot longer than that. All those crude oil reservoirs and stocks, the reserves were drawn down significantly during this conflict. It takes a while to build that back up again, and that also will have an impact on pricing. The third factor is I believe the market is still pricing in varying degrees of risk. If I look at Brent ICE futures out to late this year, early next year, we're still seeing barrels financially in that $80 per barrel level. So it all points to continued discrepancy between physical pricing and financial pricing. So back to your original question about airfares, they're not going to, there'll be some movement down, but I think the carriers, from a risk standpoint, not to mention the fuel bills they get from their suppliers, I think it's going to be still several months until we start to see any kind of market relief on airfares.
Do you think it is likely that eventually, I take your point, it could take 3 months or longer, but eventually we could see prices return to what they were before this conflict started?
Yeah, I mean, for example, something we monitor, the crack spread this year, that's the refinery margin between crude oil and jet fuel, spot jet. This year, the U.S. Energy Information Administration was forecasting $28 a barrel on average. Crack spread right now, it's around 85% higher right now, and that's what's being reflected into your higher ticket prices, whether that's base airfares or surcharges. At the end of the day, we all just pay one price. So I think, for the next several months, it's going to be tough to see a major retreat, but we're hopeful by end of first quarter next year that we're kind of getting back to where we were hoping to be early this year. Certainly all the global carriers, and I'm not trying to gloss this over, the International Air Transport Association, representing 85% of global scheduled air traffic, they just slashed their global profit forecast from $45 billion down to $23 billion. That's a huge hit. And we tend to look at things in terms of per passenger. I mean, this is not a profitable business to be in. It's tough. I mean, we're going from a hoped $9.10 average per passenger profit of IATA carriers down to about $4.50. That's like vaporware. So still challenges remain structurally on the oil and jet fuel refining side. And again, it's global pricing. Even you've heard from the U.S. president talk about all their additional activity in the U.S. Gulf, the shale play. But the reality is all of our prices are set in global energy markets, and it's going to be still some time structurally until we can get back to where things were at the beginning of this year.
And the Middle East was one of the world's most important connecting regions as well, right? Like, how disruptive was the conflict to long-haul travel?
Yeah, like I mentioned again, like the Air Canadas, the Lufthansa, the bigger players that have some pricing power through the network optimization, dropping some unprofitable routes, increasing fares. They've been able to mitigate a good chunk of that pain. But those carriers that relied on what we call sixth freedom traffic. So think about Emirates in Dubai, Etihad in Abu Dhabi, Qatar Airways in Doha, Qatar. Those carriers relied really upon those big, massive hub traffic. They're going to take longer to rebound, and I mean they're still flying, and I see in Toronto, I see the Etihad and the Qatar and the Emirates aircraft, but it's going to take a while to get back to where they were. They've lost a big amount of money, and while they were out of action because of the conflict, the European carriers, in particular Lufthansa Group, Air France, KLM, IAG, which is British Airways, Iberia, and others, they moved in to backfill the lack of capacity via the Gulf nations. So they've actually picked up a bunch of business, and they don't want to give it back to the Gulf carriers anytime soon as well. So I think that alone, as we get into, especially later this year, might exert some price relief in the marketplace, because competitively speaking, all those Gulf carriers want to repatriate the business they had lost. So I think we're going to see in some routes into the Indian subcontinent, for example, there are going to be some reasonable reductions of pricing.
That was Robert Kokonis, President and Managing Director of AirTrav Incorporated. Well, Canadian fintech company Nuvei is making a major bet on global payments. Our conversation with the CEO is right after the break. Stay with us. Nuvei is expanding its global footprint. The Montreal-based payments company has agreed to acquire Payoneer in a deal valued at approximately $2.75 billion US. We got more from Philip Fayer, the CEO of Nuvei.
Nuvei has been extremely successful on the pay-in, helping our customers, connect with their customers to collect funds in currency in markets where they operate around the world, about 52 different markets where we're licensed. And today we're operating with the acquisition of Payoneer on the other side for them to do cross-border and payouts. So the combination is extremely exciting. It creates a unique infrastructure capable of handling all forms of fintech requirements for our customers around the world.
Okay, can you expand a little bit more on what Payoneer brings to Nuvei that perhaps your company could not do on its own, or would take too long or too much money to do on its own?
Yeah, for sure. In simple terms, we manage pay-in. So if you're a business and you want to accept payments from a customer in Colombia or the United States or anywhere around the world, one integration to our platform, and we'll manage the ability for you to collect those funds. Payoneer, on the other hand, does the exact opposite. So once you've collected those funds, we'll deposit them in a local bank account. Payoneer allows our customers to have virtual bank accounts and be able to receive funds from multiple sources. Typically, where Payoneer operates are Amazon, Etsy, eBay, TikTok resellers. Well, they'll consolidate that, receive the funds, and then enable real-time cross-border payments. So the combination is really the other side of the coin that we operate on, which is just an incredible opportunity for the combined companies.
Okay, I want to talk about your clients in just a moment, but the companies are going to, as you say, together support more than 190 countries, I believe, and territories. How important is it today to have that global scale?
It's critical, and not only the countries that you operate, but there's also licensing. So, Nuvei is licensed in a myriad of countries. Payoneer's licenses are an extension to ours, including licenses highly desirable in China, as well as India, amongst others. So it's a licensing, it's a local operation, it's a local capabilities, and merging the two together is really a wonderful cross-sell opportunity.
I was going to ask you about the Chinese and Indian markets, how important or how key to the acquisition were the access to those markets?
Very much. We're enabling customers around the world. And if you think about it, China and the United States are locomotives, and the ability to support Chinese businesses as they continuously expand their footprint around the world is exciting, as well as having that local license to repatriate to operate within the Chinese framework, which is, a new framework that many companies are struggling to adhere to. So this is extremely additive to our current roster of clients that are either, operating in China that are looking to receive funds from around the world, or expected or looking to enter the Chinese market.
Are those countries, as you sort of touched on, faster to embrace different kinds of payment methods than perhaps North America or at least Canada?
Well, they understand it quickly. It's fascinating is some of our large Asian companies are opening a new market a month. So just their growth is unbelievable. And to enter those markets, you have to have all the local payment rails. So most people think, I'm going to set up and I'm going to set Visa, MasterCard, but there's local payment options. You think about Canada's Interact, but sometimes there's 5 or 6 different requirements that you need per country, both on the way in and the way out. So yes, it's fascinating. They need the payment mediums. They need the ability to both collect and pay out. And their appetite to expand globally is insatiable.
Okay, so let's talk a little bit more about clients. You mentioned, for example, Payoneer has some of the bigger clients because you're looking to serve digital commerce, essentially, the Amazons or the Etsys, those kinds of businesses. Did you already have those clients on your own, or are they coming through you through Payoneer?
A little bit of both. So, Nuvei services great brands like Microsoft and Ticketmaster and others. Payoneer, and we have a smaller marketplace business. Payoneer has an extremely successful marketplace business where they've been focusing on the Amazons, the Shopifys, the Etsys, and others. The combination is so attractive just because we're going to help them go up market, and we're going to be able to execute around, paymentizing the marketplaces that they support today.
Let's talk a little bit about fintech in Canada. How would you describe the ability to easily adapt fintech in Canada compared to some of the global peers?
Look, I think Canada, first of all, in fintech for us, it's borderless, right? Because businesses have to operate around the world. I think Canada has an incredible framework now. We've set up the MSB. We set up licensing in Canada now that I think has created more clarity around it. But Canada is still such an attractive opportunity. We have great talent, great know-how. We have nothing but capability in Canada. So the way I would frame it back is fintech is an important part. I'm really proud to be Canadian. I'm really proud of our Canadian innovation. And there's so much can-do opportunity in Canada, but it's not restricted to the borders of Canada. We're born here, but we operate, around the world with 5,000 employees. Okay.
Are there 1 or 2 things you would do within the country or ask of the government, for example, as it moves more towards modernizing the law that they could do, either sort of through regulation or licensing?
Yeah, the couple that come to mind is we've been slow on stablecoin and digital assets. I think that is a wonderful opportunity. I think the fact that we've now set up MSB and regulation is a positive, and Canada's moving in the right direction. But overall, we should be innovating here, right, to bring investment dollars up to Canada so that we could be pioneers. Other countries have been ahead of us. I think stablecoin movement is positive, but we're still many years behind what's just south of the border.
All right, Philip, what else for this current deal? When will it be complete? What else has to shake out before that happens?
There's a regulatory framework, so it'll be first half of 2027.
That was Philip Fayer, CEO of Nuvei. Well, the G7 summit is underway in France as world leaders grapple with a potential breakthrough in the Iran conflict, global energy security, trade tensions, and the future of AI. We'll go over the biggest themes from the summit after the break. Stay with us. Oil prices are falling after the U.S. and Iran have agreed to extend their ceasefire and reopen the Strait of Hormuz. But significant challenges face the agreement ahead of its signing on Friday in Geneva. Prime Minister Mark Carney is in France for the G7 summit. He says the war in Iran will be the main topic. Carney says a durable ceasefire must ensure safe transit through the Strait of Hormuz and address Iran's nuclear program. And shares of Fox are under pressure in today's trading. This comes after the media giant announced it is buying Roku. The deal is worth $22 billion US and will give Fox access to more than 100 million global subscribers. The G7 Leaders Summit is kicking off against the backdrop of a reported U.S.-Iran agreement to end hostilities and reopen the Strait of Hormuz. So joining us now is John Curtin, Professor Emeritus at the University of Toronto and Director of the G7 Research Group. It's great to have you join us. Thanks so much.
Good to be with you.
How significant is this reported U.S.-Iran agreement, particularly during the week of the G7 summit?
Oh, it's very significant indeed, and it's great good news. Iran was always going to be the top of the mind issue at the Evian summit. It was first on the agenda for the G7 leaders to tackle when they first met for dinner this evening. But a day before they started, came the news that finally a deal had been done to basically stop the United States and Iran shooting at and killing each other. A ceasefire now lasted 2 days, and that allows the opening of the Strait of Hormuz, so the fuel, the food, the fertilizer can freely flow out, and so many people around the world depend on it. As a result, instantly, the market gave it a seal of approval because the price North Americans pay at the pump for their gas when they fill up their internal combustion engine vehicles, it just plunged. So. And I think there'll be broader good news for food prices as the days go by and the ceasefire remains in place.
We know Prime Minister Mark Carney has said Canada is prepared to help restore secure shipping through the Strait of Hormuz if it were to open. What role can Canada realistically play there?
Oh, it can play a number of roles, but the key one is we have to put warships in the Strait of Hormuz together with all other G6 allies, everybody but the United States. And all have said they'd do it. French President Macron reaffirmed that commitment today. He said, he's got an aircraft carrier going there. It could arrive in a day or two. And Canada has just sent 2 frigates and a submarine to join with the American Navy for the RIMPAC exercises on the Pacific front. So we've got the capability. It's just where we would send them. It'll take a bit longer for the Canadian warships to arrive, but they can help out. And ever since the Battle of the Atlantic, they've had some experience in demining, and in this case, the Strait of Hormuz. And that's a critical thing to be done because the ships won't go through as long as there's so many mines recently laid bobbling in the waters there.
I wonder, when going back to the summit, just how much of it will be dominated by developments in the Middle East versus the ongoing war that we're seeing in Ukraine?
Well, the war in Ukraine, you're right, it's the next up. The first session tomorrow, the G7 leaders meet with President Zelensky of Ukraine. And once again, the G7 and their democratic ally, Ukraine, are on a roll. For the first time, we've got real evidence that Ukraine is steadily winning the war, and that the invader, Russia, Mr. Putin, they're reeling from the damage. Can you imagine? They've just instituted gas rationing in Moscow, St. Petersburg, many other cities in the heartland of Russia. An oil-rich Russia doesn't even have enough gas for itself because of the success of the long-range Ukrainian drones and missiles in taking out Russia's energy infrastructure. It does seem that the very well-respected central bank governor of Russia is now under house arrest, presumably for not printing more money to help bail Putin out. So we know that's a strategy that can't last very long. And Donald Trump and Putin, in their latest call, agreed that Donald Trump should try and end the war. He'll try by talking his European, Canadian, Japanese allies to doing a deal and letting Putin keep some of Ukrainian territory he couldn't gain by force, whereas Ukraine wants every inch of its territory back. So I think it'll be longer before Putin realizes that he's better just pulling all his troops back to Mother Russia and trying to tell his people that he won the war as best as he can.
Right. Okay, so much to watch for during this summit, but we'll have to leave it there. John Curtin, Professor Emeritus at the University of Toronto and Director of the G7 Research Group. Appreciate your time. Thank you.
Okay, pleasure.
Up next, Canopy Growth has released their fourth quarter earnings results, and we got more from the CEO. That conversation is next. Canadian cannabis company Canopy Growth reported 27% net revenue growth in its Canadian medical cannabis business in the fourth quarter, and we got more from the CEO. Take a listen.
The bulk of that growth was organic, and the acquisition of MTL came in the very last few weeks of fiscal 26. So all this was driven by the hard, dedicated, focused work of our teams as we continue to improve the quality of the services and the products that we provide with our medical patients across Canada.
Okay, obviously, as we know, you operate in other countries in the world as well, distribute there. So international cannabis revenue increased by 68% in the Q4 time period for you. I know there were supply chain challenges previous to that. So was this a rebound effect?
It was absolutely a rebound effect. We've proven in Europe when we have quality flower available, we can do extremely well. Sadly, we were challenged during fiscal 26, and we focused quite a bit of effort in making sure that we reset our supply chain, our global supply chain. So lots of effort going into cultivation in Canada and into deploying resources in Germany to make sure that we could reignite this market. And we're thrilled and we're encouraged by what we saw in Q4, 68% growth year over year. I was in Germany and Poland last week. Our teams are ready. They're on the ground. We've already rebounded in Poland, where we rebounded to number 3 position in Poland behind availability of great flower. We've shipped our first MTL strain to Germany very recently. So we're very confident that we will achieve significant growth in fiscal 27 across Europe.
Okay, so what was the challenge with the supply last year? Was it quality of product? And I see you have an inventory charge of $10.7 million. I'm wondering if that has to do with switching suppliers.
They're separate issues, and at Canopy we aspire to be one of the global leaders in bettering lives through cannabis, and this starts with quality flower, quality flower grown at scale, efficiently, consistently, and frankly, our system and our resources weren't geared to produce that reliability, that consistency, that quality of flower. So that's why we went back to basic. We re-engineered the business. We acquired an MTL, and one of the key drivers of the acquisition of MTL Cannabis was their know-how, their knowledge, their capabilities in growing good quality at scale. And we're now in a position with the integration of MTLs. We've been operating together for the last couple of months. We're seeing tremendous improvement in the quality, the consistency, the efficiency at which we now grow flowers. And we're confident now of the robustness of our global supply chain to bring great products to Europe.
All right.
Now,
the 10.7 million charge for inventory, how did that originate?
Yeah, that happens. This type of things happen when two companies get together, where you've got redundant inventories, overlapping inventories, brand, product categories, and everything. So we moved swiftly in the first couple of weeks of our integration to make sure that we would start fiscal 2027 with what you would call a cleaner slate, where we've got focused inventories, focused portfolios of brand and SKUs to really continue that growth that we saw in fiscal 26, both in Canada and in Europe.
Okay, so that would be a one-time charge there.
Absolutely, absolutely.
Okay. Adult use cannabis revenue grew only 1% for the last quarter, despite stronger performance in vapes, I guess, and infused pre-rolls. So what's preventing faster growth in that segment?
Yeah, there was a bit of a slowdown in the last quarter, but the trends are about 3 to 5% growth in the Canadian rec market. And for focused discipline LPs, operators in Canada, there's still tremendous opportunities for growth. For us, we continue our efforts. Our brands are stronger. Our portfolios are stronger. We invest more in innovation. We're focused on three categories that still represent for us a tremendous amount of growth. It's flower, high-quality flower at a variety of prices. It's infused pre-rolls and pre-rolls that are still growing extremely fast, and vapes as well. So we're very confident in the underlying fundamentals of the market that represent tremendous growth for Canopy.
Okay, you're also in medicinal marijuana. The U.S. is reclassifying that to more align with the states. How does that affect your company?
Yeah, for us, there's no real impact short term, man. We're very disciplined. We're focused. For us, we've been very clear, and we've been saying the same messages. We're focusing on the fundamentals. We're building really strong foundation in Canada. We're focused on the near-term opportunities that will drive Canopy to positive EBITDA and positive cash flow generation. So for us, it's Canada and it's Europe, and it's paying off for us, as we saw in fiscal 2026, and we move into fiscal 2027 with really good momentum. So we will not move away from that focused strategy. That being said, we know the U.S. market will eventually be an extremely large, sizable market, and we're very encouraged by the positive inclination of this administration to gradually change the regulation of the market. So we saw improvements on the medical side of things. Does not impact Canopy, but it's a great move in the right direction. And we're staying close to what this administration is doing with the cannabis market.
Okay, the last quick question here is about the illicit market in Canada and what challenges, if there are still challenges, that remain there.
Yeah, it is still a very large market. For us, with other LPs, we focus on improving the quality of our products, the quality of our innovation, and working on efficiencies and cost control to make sure that our products really honestly rival and exceed the performance of the illicit market, and where consumers turn more and more to our products when it comes to satisfying their needs.
That was the CEO of Canopy Growth. Coming up, the FIFA World Cup is underway. We will break down the cost of renovations at BMO Field. Stay tuned for that after the break. The City of Toronto's budget to host the FIFA World Cup is $380 million. $153 million of that is for capital costs, which includes stadium upgrades. BNN Bloomberg has obtained a detailed breakdown of the renovation costs, revealing just how much was spent on each upgrade and whether those investments will keep paying dividends long after the final match. Usually known as BMO Field, Toronto Stadium is now ready to host one of the world's largest sporting events.
We're in the tunnel right now, which is an unbelievable place to be. This is where the teams will line up before they go onto the pitch. And so we've had to widen the door here to ensure that there's a big, beautiful, wide broadcast shot of those players and the kids coming out onto the field and then walking into what is going to be an unbelievably packed and really amazing football stadium for the World Cup. So can't wait to see it in action.
2 years of work in the making for the 6 group stage matches that will be held in Toronto. The city spent more than $132 million on upgrades, while MLSE contributed $25 million for a total of $157.9 million. Many of the upgrades are requirements by FIFA, including adding 6 lockers to the change rooms for a total of 26 lockers. There are also new LED video boards, one in each corner of the stadium, and audio and technology upgrades. There are new hospitality suites, which is one of the bigger permanent components, as well as upgrades to the restrooms. And there was also modernizations to the stadium lighting to match FIFA's television and broadcast requirements, and brand new turf.
We did. We were one of the very few stadiums hosting the World Cup this summer with natural grass. In fact, FIFA came through years ago and they said, you can host a match right now because they love the pitch that we already had. But as mentioned, we wanted to have the absolute utmost quality for a World Cup.
Stephanie Jones with Maple Leaf Sport and Entertainment says the grass was grown in a greenhouse by Green Horizons and was laid down on site in late 2025.
We laid down the sod in November and December and then stitched it all together. So we've got 5% of stitching amongst all of the blades of grass, but we're ready for it.
There was also an upgrade to the video production control room and public announcement systems.
And one of the largest broadcast compounds we've ever built in sports in Canada is built on the south side of the stadium.
Additional costs included pre-construction and soft costs, as well as direct costs for insurance, equipment rentals, demolition, and mechanical work. And the biggest expense of all, the temporary grandstands. 17,000 seats have been added to this stadium, which is a requirement set by FIFA. Just to host the group stage events, the threshold is 40,000 seats. So here at Toronto Stadium, that's an extra 10,000 seats added to the north end and another 7,000 seats added to the south end. It's a lot of work and a lot of money. And so the question has to be asked, was all of this worth it? What's the long-term return on investment?
What is important about those infrastructures, and different folks will talk about it here, is it allows them to continue to bid for more things moving forward.
Sherry Bradish is the director of the Future of Sport Lab at Toronto Metropolitan University. She says the investments will help to build Toronto's legacy as a city that can handle hosting mega revenue-generating events.
I think what we're going to see in Toronto is definitely a long tail of legacy. And I think it will be more in programs we're going to start to see roll out attached to soccer pitches across the country. What you want to ensure is that the venue and the infrastructure that you're committing has a legacy plan for the citizens.
The city, the teams can't sort of sustain a 45,000 seat stadium at this time. And so that's why we went with temporary seating. There are a number of things that we're doing at the stadium that are actually legacy projects. So the new video boards, new lighting, new audio, new pitch, new concession stand, technology, et cetera, that will all be legacy items that improve the fan experience and the broadcast experience long after the tournament is over.
The big FIFA stress test happened about a month before the World Cup, when TFC welcomed Inter Miami to the stadium. MLSE was confident it would be a sellout crowd for one reason and one reason only: Lionel Messi.
It's really about people movement. That's the test. Everything else, we know how to operate a stadium, but now we have to look at operating at 45,000 capacity.
A sellout crowd of 44,828 fans, including about 17,000 spectators in the new grandstands. Some seats remained empty at kickoff, though, as fans were still making their way into the venue and through the concourse. It's a problem that was quickly addressed. In a statement to BNN Bloomberg, MLSE says, as with any review, we identified areas for improvement for wayfinding and continued optimization of concourse line management. We asked MLSE whether there would be additional costs associated with the tweaks, but the organization would only say final project costs will be confirmed by the city. Not only did the game serve as a live preview of World Cup-level venue demands for the city and MLSE, but with the stands full of buzzing fans, it offered a snapshot of just how much of an economic lift these games could be for the city and the country, and the legacy that could follow.